Hello traders. So I want to talk a bit about indicators. I mentor quite a few people who I try and wean them off their reliance on indicators and get them onto price action. But human nature always means that you head back to where your comfort zone is. And unfortunately, a lot of people's comfort zone is with indicators. Now, the key problem with indicators is that they are lagging. So they are using data that's happened in the past to try and predict the future. But yes, they can work, and a lot of people do have successful strategies with it. But it also allows you to get into trades at totally the wrong time. So, for example, if you're doing an RSI trade, you'd be getting in when the RSI, so you'd be going long when the RSI is at the bottom. And I think, let me just show you some of the things there. So you can see what I'm doing. RSI, which is probably the most common one, okay? Obviously, when it's down here, we're looking for a long. When it's up above the 70, we're looking for a short. Okay, it's all fine and well, but let's just have a look here. So you would have been looking for shorts all along this area. Meanwhile, the trend is to the upside, and price action is dictating that there is no short here. So because these are lagging indicators, a lot of the time they will stay overbought, oversold for extended periods of time before actually making a turn. Now, I've seen charts that kind of look like this. Um, this gives is another this candlestick, and then we have another favorite one is the MACD. MACD. Okay, so I've seen charts that look very similar to this with multiple indicators and oscillators on the chart, right? And what's happening is people are essentially saying, well, when all of these things are grouped to the bottom here, we need to go long. So granted, there is a long brewing here, you can see that. But does price action say that we are a long? You know, so if you look at that level there, so there's the main level, okay? But we have grouped, everything's telling us that it's time to go long, but we've grouped just on a break of the 200 moving average. So essentially, we're looking for a proper break above the 200 moving average for this to continue. But price action is saying that it's broken through a level, which is the 200 moving average. It's broken through this level here, okay, and it's come back to retest. And remember, everything about price action is price is either going up or it's going down. It's testing the previous lows or testing the previous highs. If it breaks past those previous highs or previous lows, it typically comes back to retest before continuing on the path or alternatively turning around. So I'm very wary of relying solely on oscillators or indicators. Typically, if I do run some indicators, but essentially what I'm doing is I'm using them for confirmation. So the confirmation, if we look at this area here, and this is the other problem, we've got some little space on your screen with all the crap on it. So if you look here, you can see diversions, and for me, a lot of these indicators are great for diversions, telling me what's going on. But I've got a warning here. So the indicators here have indicated that there is a potential change in direction happening. But price action is telling me that we've broken through this level. So I would expect us to go and test this level. There's also a gap to the top. But I would expect a test, and if that test succeeds, then then you can take the trade. But if you have a look here, so we broke back through this level. We got up to this level here. So you can see that here is a breakout, there is a breakout, and there is a breakout level. So there's multiple levels here where price can go back. So this level was never tested. Price went back, test that level and came back. So yes, indicators do help you to confirm what is happening, but they are lagging. So the reality is I've really used them and I focus on price action. Now, market conditions are always changing, and we're just the little retail traders who are trying to hop on the bus that the big institutions are creating. So when the big institutions and the banks and governments decide that they're moving the market in a direction, there's no ways you're going to be able to change that direction with the trades that you're taking. So you need to try to get on with that bus. Now, the thing with institutions is they keep changing the algorithms of how they trade because they're looking for a competitive edge on their competitors. And the same is true with the retail traders. Why retail traders tend to always go towards a new indicator. And why they're looking for that is they're looking for a silver bullet. And I think the sooner retail traders get into their heads that there isn't a silver bullet, price action is your key element. When you start looking at multiple indicators, look for indicators that are relevant to price action. For example, like Bollinger Bands. So Bollinger Bands is a great example of the Bollinger Band is really, let's take this purple to something more. And also, my method is always exponential. It just works way better, and I can read the charts a lot better. But Bollinger Bands always give you an indication, because it is related directly to price action, that you can see what's going on. And you can do your own research on it, but Bollinger Bands allows you to see W reversals, and I think, let me just go to I think there's some on the weeks here. Yeah. So here you can see price moving down, moving down, moving down. So we are outside of the Bollinger Band here. And if I draw a line along the price, you can see that we're getting closer to the Bollinger Band. So we closed outside, and then we're inside the Bollinger Band here. So this is a W reversal. So from a price action perspective, what does that mean? Well, this is essentially a range. And when the range breaks out and comes to the retest, we'll just copy this and move it to the upside. Our target is the top of the range, and there you can see top of the range before we came back for another retest of the breakout. So learning price action is by far the better method, and then bringing in a oscillator to actually back up what you're thinking. And I'm going to pull in the Bollinger Bandwidth here. So Bollinger Bandwidth basically is telling you when there's a squeeze. Okay, so you can see here where these bands are close together. The Bollinger Bandwidth oscillator is around the bottom, which is indicating the squeeze. It starts moving to the upside. So there's a breakout imminent. But for us as retail traders, a breakout, it still moved down 1,700 points before that breakout happened. So oscillators are always going to be lagging. So you need to keep that in mind. And your focus should really be on learning the price action. And, a lot of people who I refer to the different price action websites and the guys out there that have got some really good material on price action, people tend to look at it, think they understand it, and then move on. But then often coming back to me and saying, well, I'm going long here, I'm going short here. And it's a total wrong area to get into the market. So, I know people that trade, only trade the fractional breakouts. So if I come to, let's just take it to a 15-minute argument's sake. I think I'm going to get rid of this Bollinger Band. Okay. So people that trade the fractional breakouts. So in other words, if we break below this fractional, like we are at the moment, we're kind of hovering down here at the moment. Okay, although it is after hours trading. So if we break below this fractional, then they'll trade the short. If we break, the next fractional here is up here. So if they break above that, we'll trade the long. So that is a price action strategy. A lot of people also trade the opening range. So what do I mean by that? Let's just take yesterday and I will use this. So there's two ranges that basically take place, and the one starts at 8:30 and finishes at 9 o'clock. Okay, so there's the range, and you trade the breakout to the upside, and most of the time this is your first target, this is your second target, this is your third target. That's the one range. Then the other range, sorry, that's on the South African market. On the European market, you can either trade the first hour as the range. So let us go back here. So you can go from 9 o'clock till 10 o'clock, or you can go from 10 o'clock to 9 o'clock. So essentially, that first hour bar of the day is what your range is. So 10 o'clock, 11, 10, 9. So there's a range there. So there's a range over there. And remember, the times I'm talking are South African times. So you need to look wherever you're trading, you need to look where, what the time is for the market that you're looking at. Okay, so that's the first hour. And then the second hour of trading was pretty much in the same time frame. So there it is there. It's just a little bit below. But you can see a breakout of this range up, more profit taking there. You can see the 200 moving average also in the same area and moving up. So range breaks are price action strategies. So you can see here you have essentially a double bottom as well. So you've got a bottom there, bottom there. This is the double bottom. And you can grab any oscillator that you want to confirm it's a double bottom. You'll find diversions on it. And this is the breakout of this height. So I don't even need the open range to do it. You can automatically say, as soon as I break above that, close above it on whatever time frame you're using, that is my area to take profit. And look at this red candle where people took profit. And you can see you've got the 200 moving average and you've got the range height here, all in the same area. Plus you've got a level of that in the same area. And then you have a Paul Williams gap sitting right there. So you can see what happens there. Right in that area. Okay, so indicators are not going to tell you to take profit there. By the time it's turned around, they would have said, okay, you need to take profit there. So that's why price action is so key, and your levels are so key. Any new trader out there, the first thing you want to do is get onto price action. Do not go and look for the silver bullet inside the oscillators or the indicators. They are really just there as a guideline. They are not there to indicate that you need to go long or short whenever that indicator hits a certain level. So, yeah, if you guys have got questions or anything, please drop me a comment in the comments below. And anybody using Pro Charts, I want to show you a pretty good indicator which we've coded. And this is really just a stochastic, but the calculation is not a stochastic calculation. The calculation is a MACD calculation. And what it is I've got 3 different time frames. So I've got a short, medium, and a long time frame. And the concept of this is basically straight out of Dr. Clive Roth's trading manual, is when they group to the top, there is a warning that something's about to happen for a move to the downside. When they group to the bottom, there's something about to happen for a group to the upside. And it doesn't matter what time frame you use it on, it comes up and gives you the warning. But you can see the warning here is for quite a long time. So that's 1, 2, 3, 4, 5, 6, 7 days before it does move to the upside. But immediately you can see not all of them grouping there, but 2 of them are grouping to the top side, which is giving you an indication that this downward move is still not finished, and that would have been an entry for another short. Okay, so if you want to get your hands on this, just drop me a comment below, and I'll send it to you. You can actually install it on your Pro Real chart. But this to me is an indicator that I use pretty often in looking to see what the situation is, especially if we're sitting in a wedge and we've had a breakout. If everything's grouped to the top, I'll wait for the retest, and you'll find that the retest will come to the bottom of the wedge, will come to the retest of the wedge, but all of these indicators will group to the bottom, indicating a move to the upside. But again, you can see here, it doesn't always work, because here you have a very strong uptrend, and it is warning you that there's a turn about to happen. It then pulls back, and then pretty much telling you, well, going back up, and it carries on back to the upside. So price action is always key in it, and in this one here, this was essentially a measured move from there to there to there. Okay, so what I mean by measured move is the height of this here, so from the bottom here, and because there was a breakout, and then we consolidated. So this height is always a second move. So I can copy that segment and I move it to there, from the very low there, and 9 times out of 10, that's the area where you'll take profit. Okay, so this is where theories like Elliott's wave and the likes come to play, because you're moving up in waves. So 1, 2, 3, 4, 5. And then you're looking for a 3-wave correction, which is 1, 2, 3, and then you move up in a 3-wave connection. So depending which strategy you're taking, the market's always moving in 2s or 3s or 5s. And there's a number of things around number theory as well in ichimoku, which shows you that. So yeah, so even moving averages, Bill Williams theories, ichimoku theories, which I use quite extensively, they're really just a guideline. And be careful of getting stuck with an indicator and assuming that the indicator is going to give you the holy grail of trading. Rather spend some time and effort on learning price action properly and studying it. Go back test it, and learn that every single breakout is an area or a potential area where something is about to happen. So every tail tells a story, I suppose, and every tail here, something is about to happen. It's either going to respect it or it's going to break through. So, break through, then you're immediately looking to the left to see where it's going to. I challenge you, try it, clear your chart of all indicators and oscillators and strategies, and just go through the price action and draw your lines in and see how price behaves to the breakouts. And if you start focusing on that, you'll immediately start getting better entries, because you'll realize that where what the institutions are trying to achieve. There's one thing that they can't change, and that's the way a candle behaves. So the minute somebody steps in for buying, for example here, people stepped in for buying on the 200, everybody else climbs in on it and pushes the price up. It comes back, and we have another attempt to push it below. It failed, and the buyer stepped in. So again, all the people that are watching the price action are understanding that this bar here is a rejection bar off 2 levels. So there's a high probability that we can push it further. So we go long, and we have the confidence that the long will stop here, and we can wait for it to see where it goes to. And obviously things like breakouts are always important, and you can see there we broke out, came back to retest the breakout with one or 2 bars, and we also know that that's not enough of a retest. It will come back sometime in the future. Right there it came back, and it hovered around there before breaking back to the downside. So price action is key. Try and get rid of your indicators, or keep it to 1 or 2 which you use for a specific task. So for me, it's looking for diversions. It may be for you just to get, for example, with the stock MACD, is saying, well, everything's grouped to the bottom, so there is a chance for a move to the upside. Draw your trend lines in so you know that whether you are in a bull trend or in a bear trend. So for me, this is on the DAX is currently a bear trend, but I believe that markets are designed to go up. People don't want to lose money. So shorts are always scalps, and your long entries are the ones that you can let run for a bit, provided you have the right entry. Anyway, guys, I hope that helps. Any questions, any comments, please put them in the comments below. And I'll catch you guys later.